Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. So in one of the recent YouTube videos, we discussed the fact that dumb money was rushing into this market rally. We took a look at what that typically means when you have dumb money rush into the market. We took a look at what that typically meant throughout a bull run, throughout bull markets, and what that likely means today. So in this video, we're going to be looking at what smart money is doing. And as the title of this video does suggest, we do have some similarities between what is happening today during this topping formation in 2007. Ultimately, that is where we are heading. The yield curve, the signal from the bond market that we're currently seeing, that's deeply inverted to an extent that we haven't seen since the 80s. This signal has time and time again anticipated a weakening of the labor market, a rising unemployment rate. People lose their jobs as companies go bankrupt and they stop spending. That's called a recession. You can see the bond market, this blue line mirrors what the unemployment market is doing. So if the signal that we are seeing today looks anything like every single previous moment throughout history, we should see the unemployment rate rise somewhere in 2023, probably towards the end of 2023, we'll have the unemployment rate trending higher. Now, of course, that comes together with the first inflation breakout since the 70s. We've done many videos on this, the low inflation environment that we've had throughout the past 40 years since 1982 has propped up the market. The fact that inflation has broken out represents a destabilization of the financial system and is probably going to lead to the end of this bull run that we've seen since 1982. Now the question is that going to happen now? And that's where we can look at indicators like smart money to help us understand and time the market. Now, of course, these videos are just our opinion based on our research, based on how we understand how the markets work. They're not designed to be a crystal ball, but give you our opinion on the market. Make sure to subscribe to the channel if you haven't already, if you are new here and you want to see more of these types of videos. And of course, don't forget to smash the like button because that helps out the channel tremendously. Now, without further ado, let's get into the smart money indicators. Now, commercial hedgers, whether that's on stocks or commodities, they are typically seen as smart money. Their job is actually to take the opposite side of retail traders, so smaller speculators, and you'll see that very often they are able to time trends perfectly. You can see when this indicator goes below that red dotted line, it means that hedgers are net short on the market. You can see when that specifically happened in January of 2022, right before the market started to collapse. And you can see these hedgers also turned net long right here as the market was approaching its bottom in September of 2022, and also in fact you could argue in June of 2022 these hedgers were getting very optimistic on the market at the same time as we were on gameoftrades.net. Of course, the market hasn't rallied very significantly since, but if we do continue rallying, June 2022 will be looked back upon as a very good buying opportunity. You can see again here, COVID, SP500 hedgers go net long at the bottom. They go net long here before a nice rally in 2018, net long in 2016 right here before a beautiful bull run. And really, you can see countless examples. 2011, again, net long right here at the bottom. Now, of course, that looks incredibly promising, very accurate indicator in these instances. And this is where I really want to get to on this specific indicator. You can see commercial hedgers went net long here in 2007, right before the big crash. So they don't always get it right. In fact, this look right here doesn't look that far off from what we have here in 2022. So while in many of these instances, commercial hedgers going net long is a very accurate bottom signal, in 2007 it was actually a top signal. And if I put a moving average on this indicator, you can see, in fact, commercial hedgers were very much extended to the long side right at the beginning of the bear market. So of course, you had this mark a significant bottom in 2016, this mark a significant bottom in 2018, 2020 again. Commercial hedgers got it right in these four instances, but not in 2008. So what's the conclusion that we can take from this chart? S&P 500 commercial hedgers take the opposite side of retail traders, small speculators. And so the majority of the time, you're gonna get it right by following what these hedgers are doing. And so here, as long as we stay in a relatively stable macro environment where inflation is coming back down, the Fed is perhaps starting to hint at the end of its tightening cycle, and we haven't seen unemployment really begun to take off like it did in 2008 and 2000, well, you should expect this to prove to be a great long signal for the market, as it so far has proved out to be, right? The market is up quite significantly since that bottom in October. But what we can also take as a conclusion from this is that these hedgers don't time the macro environment. In 2008, they never provided a sell signal until the very, very bottom. So if you do start to see the macro environment deteriorate, and as we discussed at the beginning of the video, that's very likely to happen later in 2023, at least that's our opinion, well, you're probably not going to see commercial hedgers time these moves. If you are so far enjoying this video, by the way, make sure to smash the like button by scrolling down below and hitting that gray thumb. It helps us out tremendously. It helps push out our videos. It is really appreciated. Now let's take a look at a second smart money indicator, and that is the OEX open interest ratio. And this is another smart money indicator, and you can see it's very obvious from this chart. These are professional traders that do time reversals in the market exceptionally well. You can see right here this spike in 2020 timed the top of the market beautifully. You can see this big spike here towards the end of 2021. OEX traders were going heavily short towards the end of 2021. Very interesting, right as the market was making its top. And again, you can see right here, let's zoom in August of 2022 on this rally right here. OEX traders called the top of the market right here and the bottom right here in September. So very interesting. I'm always fascinated by how accurate some of these calls have been from this indicator. OEX open interest calling a drop right here in December of 2015. Look at what happens in January of 2016. The market drops around 15% in just a couple of weeks. Now let's fast forward to what is happening today with the recent rally, and it doesn't seem like smart money is in a rush right now to start betting on downside like it was in August right here. So that's interesting. That's a difference to what we had in August, is that this smart money indicator is not showing us that we should be expecting a lot more downside here. Now, this is where I want to do the parallel with 2008, because in 2008, what you could argue is a very similar situation where you had OEX open interest rise here leading up to the top. You can see here 2006, 2007, open interest was rising as the market was rising towards its 2007 top before 60% crash here. Open interest was all over the place, very similar to 2021, open interest rising towards the top. And then after the initial drop here, the first part of the bear market, OEX open interest laid flat throughout the rest of the bear market. So OEX traders timed the top, but they never provided a real sell signal throughout the rest of the bear market in 2008. So very similar situation to the SP 500 hedgers position. The smart money indicators time the market because they go against retail. But for example, in 2008, when retail was all doom and gloom, expecting things to continue getting worse, just because that had been the trend over the last few months, very similar to today, well, things actually got worse and the market actually did go down. So sometimes it's these smart money hedgers that are not able to time the market. Now, currently we're on weekly bullish momentum. There's a lot of fear in the market, a lot of speculators that are betting on downside, especially as we hit this downtrend line. I think, there's this big risk of a short squeeze if we do eventually take this trend line out. But ultimately later in 2023, we're heading into a recession. Earnings are going to get hit later this year. People are going to lose their jobs. So it's going to be a wild ride, perfect for traders and likely very tough for passive investors. We have a model portfolio and we place the trades that we think are going to outperform in the macro environment that we expect. We added Bitcoin to the model portfolio at $19,000. It's been on quite an impressive run. Our goal is to make sure that you are taking advantage of all of these trades as we're posting them, highlighting the key levels, our targets, making sure you don't waste your time going through lengthy reports and you can absorb as much information and as much actionable information as quickly as possible. Now, in fact, because you stuck around to the end of this video, you can find a discount code in the description below that's going to give you a 20% discount on the service. It's only going to be available for 24 hours. So if you want to test out our service at a discount, make sure to take advantage of that. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash the like button. Don't forget to smash the subscribe button if you are new here. And of course, good luck on your trading, and see you next time.